Hey guys, and welcome back to the channel. For those of you who are new here, my name is TeamHoeffer and I'm a residential loan officer in Phoenix, Arizona, and I teach practical money tips so that you can make a smart home purchase. Today on the channel, I want to go all into down payment strategies, what to do if you find yourself having to make up the difference between your purchase price and your appraised value, if you're bidding over asking, what should you be preparing for cash to close. Now, before I get into all of that goodness, I am going to ask you to like, comment, and subscribe to this awesome channel so you never miss a mortgage and money tip video in your future. So I think the best place to start this video is actually just kind of dispelling some of the misconceptions that I get asked on a regular basis about down payments. Now, this video is going to be focused on first-time homebuyers and people that are occupying their property. So just know that there are different requirements for second homes and investment homes, and this video is not on that. But essentially, it used to be traditionally that you would want to have at least 20% down for your home purchase because there weren't a lot of affordable housing options available. Home prices were much lower back then, and as home prices have increased, the government has come in with a variety of different home products to make sure that affordability was still available to the average person. So what does that mean for you? Well, if you're a qualified veteran or you're able to qualify for a down payment assistance program, that might mean 0% down. If you're buying in a rural area, that might mean 0% down. If you're like most consumers, you're probably going to do something between 3 and 5%. Conventional loans typically offer as low as 3% down if you're a first-time home buyer. Traditionally, we see more 5%, and then FHA is 3.5%, right? So those are going to be your options for down payments. But just know that that's not the only cost to factor into your budget and your planning. You also have to think of closing costs. And this is a really hard question to answer because a lot of that depends on the state in which you're purchasing, whether or not you're buying into a condo or an association that's going to add on additional fees, or it also is dependent on your loan amount. But to give you a broad answer to help you with it, I typically see that closing costs are anywhere between 2 and 3.5% of your overall purchase price. That is not to say that it can't be more if you're buying points down or buying mortgage insurance out, but on average, that's what I'm seeing. I typically don't see closing costs being anything less than $5,000, and I typically don't see them being more than $12,000. So that's just kind of a good range to base it off of. Now, I will say that anytime you buy into a condo, you have to realize that there's additional dues, transfer fees, working capital fees. Occasionally people buy homes where there's transfer taxes or assessments that need to be paid, or they're transferring on with a solar lease. So any of those things can add additional costs to your home purchase, right? But in general, this is what we're speaking about, okay? So you're thinking down payment. You also need to be thinking of inspections. So inspections and earnest money are things that are separate and have to be paid up front when you're buying your home. Earnest money is typically a percent of your home purchase depending on the agent that you're working with and what the seller is willing to accept. And then your inspections are however many inspections you want. Typically people go with a thorough home inspection, but sometimes you get a pool inspected, an AC inspected, your sewer line inspected. So just know that those are going to be additional costs. I always tell people to budget at least like $2,000 for inspections, depending on all the things that they're going to go with, but I don't see that any lower than like $500 usually. Okay. All right. So we got inspections, down payment, closing costs, right? And in this crazy market, you might be expected to pay over appraised value and then, or make up the difference in a guarantee, right? That you've promised the seller when you made your offer. So let's get into all of those down payment strategies. Where are you coming up with these funds? Okay, so the very first one that I'm going to talk about is going to be fairly conservative and you're going to be like, oh my God. But I think that most people want to know how long it would actually take to save for a down payment, for closing costs. So what I typically advise most people is that they should live on a budget that's 70% of their net take-home income because it allows for them to have 20% towards debt reduction or allows them 20% leeway to save for things like a first-time home purchase or like an automobile purchase or a big purchase of some kind. And then 10% is still left over for savings for, an emergency fund or a rainy day. And so I like that strategy. using that and, what the average income in America, which is somewhere between 62 and 68,000, it will take somebody roughly 2 to 3 years to save upwards of like $20,000 to $22,000. So what I would do in this scenario, right, is just know that like one, it's going to take some time, but if you're looking for ways to maximize the amount of cash, I would ask your loan officer for a couple things. Ask them to give you a comparison between a 3% down, 3.5% and 5%, and then also ask what your options are for bumping up your interest rate to provide lender credits. Since rates are still historically low, sometimes bumping up your interest rate 1/8% will give you a couple $1,000s towards your closing costs, and it might be worth it for you, especially if you find yourself having to make up a gap in an appraisal and a purchase price. Now, the second thing I'm going to recommend is down payment assistance. There's a variety of down payment assistance programs, as are there CRA programs with national banks. And so what these programs do is that they give affordable housing grants and bonds to people that make a certain income threshold. And so what you'll want to check is what the requirements are for your area, but typically they have an income restriction, debt to income restriction, higher FICO requirements, and sometimes even reserves. So you'll want to check what those are. But why I also like them, especially in a market right now, is that you can get anywhere between 1% to 5% to add to the funds that you already have, and it can go towards closing costs, down payment funds. You can use your funds to make up the gap between an appraisal or a guarantee to the seller. And again, it's just a great way to maximize your resources and make your offer more competitive, especially in a market like today. Now, some of the drawbacks with down payment assistance, at least in our area, is one, they typically have higher interest rates. So we're talking about 0.5% to 1%, depending on the type of program. And they have higher fees. And in our area, you have to have the loan for 3 years before you can refinance it or sell it and get forgiveness. So unfortunately, the funds are not for free. You're paying for them over an extended period of time. And so it's not a penalty. I mean, obviously, if you're able to buy now, like I said, if you own a home for 20 years, you're going to double in value. So, I mean, I think it's a great thing to look into, especially if you're trying to maximize your options. But just know that you will be paying for it. Okay, so it's not for free. All right. Third thing that you might want to consider is getting a gift from family members. Now, when you're qualifying for a home loan, typically we don't allow for loans. So these are funds that will have to be given to you by a qualified family member. So we're talking brother, sister, mom, dad, grandparents, aunt and uncle. Unfortunately, cousins, I don't qualify. Sometimes you can get close personal friend, but it is hard to document that relationship. So you just want to make sure that you're qualifying your family. And then also your donor has to be comfortable with one providing verification that they had those funds, and they will have to fill out a document called a gift letter. So it isn't something that you create, but it will have their account number, the amount of money, the relationship to you, and it says in there that they are not seeking repayment on this. So just so you know, like, we're not the IRS. I don't know what all the gift laws are, so you will have to check with a tax accountant, but it is something to look into, especially if you know your parents were going to want to give you money for a home purchase, right? It is something, we do see it quite often. And I do have a video on gift instructions. If you guys want to check that out too, I'll post it in the comments below. Okay. Next option, guys, and this is not something that my company currently offers, but I do know that I do believe that this is going to be something that's going to be more widespread in the next couple years just because of what's going on. But there is a crowdfunding option. I did find it through featherthenest.com, and it's through a company called CMG Financial. And essentially what it does, it's like a GoFundMe, but for your house. And why I like it is because let's say you have a wedding, or you're graduating from college, or you have a birthday and people just want to celebrate you and help you make an investment in your financial future. This is a really good way to get additional funds. Now, some of the drawbacks obviously are, one, you only have one lending option, which isn't great. Obviously they corner the market in that, so they don't have to necessarily be as competitive as what you can get on the open market. And then two, whenever you use a service like GoFundMe, like if you notice, a percentage of all the funds that people donate actually go to that service. So you're not getting 100% of all the funds. So it is something that you want to check on just in general. I've seen those fees somewhere upward between 5 and 12% on what they take. So just keep in mind that you're not going to get all of the funds. All right, last strategy is borrowing or withdrawing from a retirement account, like a 401k or an IRA. Now, this is not necessarily an option that I really love, but it is available to you, and I want you to know that you can do this. Now, some things you have to consider is that every employer is going to have restrictions on what you're allowed to take out. And if you're withdrawing your funds and you're not over the age of 59 and a half, there is going to be a tax penalty that you'll have to talk to a tax advisor about. But essentially, you can use these funds to help you with down payment, to help you make up an appraisal gap, to help you with closing costs. I mean, it's a really good way to help you expand your liquid funds. Now, some drawbacks, right? Obviously, there's a tax penalty. And two, if you borrow from it, you're actually repaying that on every paycheck. So you'll actually have a lower net monthly income to be able to live off of monthly, right? So just know that the funds, aren't like, there's a cost to doing that, right? And so it's either going to be in your overall monthly total net income, or it's going to be in a penalty with the IRS. The other thing that you have to think about is the opportunity cost if you were to withdraw. Right now is a really good investment time. Like, yields are typically higher than what you're paying in interest, so you are losing some investment as well. So I don't like it in my mind, and for my money mindset, it's like borrowing, robbing for Peter to pay Paul, or whatever that saying is. So just know that you can do it, but it's not necessarily my favorite way to go about this. Now, I've given you just kind of a lot of options. Again, I just want to recap that you should be discussing all of these options with a loan officer, and definitely be asking them to provide a comparison on every low down payment strategy, as well as your options for bumping up interest rates, providing lender credits, and then maxing out the amount of income that you have. I think that you guys have more options than that are available to you. And so it's super important that you talk to them and get multiple options. If you're working with a loan officer that only provides one option, truthfully, they're not working to help you get the best deal, like the best competitive strategy in this market, which you absolutely need. So we're going to be talking about this and more on the live on Wednesday. So if you have questions, bring them then. I cannot wait to answer them for you, and tune in for another money mortgage video in the future.